What's up, everyone? Today I want to share something pretty exciting. How I managed to make $32,000 in profit on SPY options between April 9th and May 16th, 2025. This wasn't just luck, it was about understanding market psychology, spotting opportunities in chaos, and having the conviction to hold when everyone else was panicking. Let me take you through exactly what happened, why I made the trades I did, and the key lessons that might help you capture similar opportunities in the future. So let's set the stage. On April 2nd, 2025, a day President Trump called Liberation Day, he announced sweeping tariffs on virtually all U.S. imports. We're talking a 10% baseline tariff on everything, with higher rates for certain countries and products. The market's reaction was brutal. Over the next few days, the S&P 500 plunged nearly 15%. The Dow lost over 4,000 points in just 2 days. It was the biggest two-day percentage drop since March 2020 during the COVID crash. Bond yields were spiking, the VYX fear gauge shot up above 60, and analysts were throwing around the R word, recession. By April 8th, we were in full panic mode. People were liquidating portfolios, global markets were in disarray, and the financial media was in full meltdown. Goldman Sachs even raised their recession probability forecast to 65%. This is exactly the kind of market environment where the biggest opportunities emerge. When fear is at its peak, when everyone's running for the exits, that's when the seeds of massive profits are planted. On the afternoon of April 9th, President Trump made a surprise announcement on social media. He said he was pausing most of the new tariffs for 90 days, except for China, which actually saw tariffs increase to 125%. It was a complete reversal that almost nobody saw coming. The market reaction was immediate and explosive. The S&P 500 surged 9.5% that day, its biggest one-day gain since 2008. The Nasdaq rocketed up 12.2%, its second biggest gain in history. It was like a pressure valve had been released. That morning, before the announcement, I had looked at SPY, the ETF that tracks the S&P 500. It was trading around $500, down from $580 just a week earlier. The market sentiment was extremely negative, but something felt off to me. The selling seemed exhausted, and there were whispers about a potential policy adjustment. So I made my move. I bought SPY call options, specifically the June 550 calls. They were trading at a significant discount due to the extreme fear in the market. The premiums were attractive because implied volatility was through the roof, but I believed that any positive news would cause a violent snapback rally. Hours later, when Trump made his announcement, those options exploded in value. But here's the key. I didn't sell. Why? Because I recognized this wasn't just a one-day wonder. It was the beginning of a major sentiment shift. The next day, April 10th, the market gave back some gains. The S&P 500 fell 3.46%. The Nasdaq dropped 4.31%. Many traders who jumped in on the 9th were shaken out, but I held firm. Why? Because I wasn't just trading the headline. I was positioning for the multi-week recovery that typically follows such extreme market dislocations. Historical analysis shows that after panic sell-offs and subsequent relief rallies, markets often experience a more sustained recovery phase as investors who missed the initial bounce begin to re-enter. Over the next few weeks, the market entered exactly that kind of grind-higher phase. The immediate fears about global trade war receded. Economic data remained resilient. By May 2nd, the S&P 500 had erased its April losses, and by May 13th, the index finally turned positive for 2025. Throughout this period, I maintained my position, adding on dips and rolling some options forward as the recovery gained steam. The options that I had purchased at the depths of panic were now deep in the money as SPY climbed back toward the 550 level. Several key developments reinforced my conviction to stay in the trade. First, inflation data released on April 10th showed an unexpected decline in consumer prices. The CPI fell by 0.1% in March, bringing annual inflation down to 2.4%, lower than economists had forecast. This eased fears that tariffs would immediately trigger significant price increases. Second, Goldman Sachs rescinded their recession forecast after Trump's tariff pause, returning to their baseline expectation for economic growth in 2025. This helped calm market nerves. Third, by early May, the U.S. and China had begun constructive trade talks. On May 12th, they announced an agreement to temporarily slash their reciprocal tariffs for 90 days while negotiating a broader trade agreement. This sent stocks surging again, with companies heavily exposed to China like Apple and Nike leading the charge. Fourth, Coinbase being added to the S&P 500 on May 19th helped fuel a broader rally in technology and crypto-related stocks, lifting the entire market. By May 16th, SPY had recovered to around $570, and my options position had grown to a $32,000 profit from my initial investment. The combination of being positioned correctly for the initial relief rally and having the patience to hold through the subsequent recovery phase made all the difference. What made this trade successful wasn't just timing the entry correctly, it was having the psychological fortitude to go against the prevailing sentiment when fear was at maximum, not get shaken out during the inevitable pullbacks. Recognize the longer-term pattern that was likely to unfold. Stay focused on data and catalysts rather than headlines. This is what separates consistent, profitable traders from the crowd. Anyone can get lucky with timing once in a while. But building real wealth in the markets requires understanding market psychology, risk management, and having a process that you trust enough to follow, even when your emotions are screaming at you to do otherwise. For those interested in the technical aspects of the trade, here's a bit more detail on my approach. I used a combination of call options with different strike prices and expirations to maximize my return while managing risk. The core position was June 550 calls purchased when SPY was trading around $500, but I also added some shorter dated calls during key pullbacks to increase leverage with defined risk. The initial options were purchased at a significant discount due to the market panic. When implied volatility is high, options premiums can become inflated, but in this case, the extreme downward price movement in SPY actually created attractive entry points, despite the elevated volatility. As the position moved in my favor, I rolled some profits into higher strike calls, essentially playing with house money, while maintaining my core exposure to the continued upside. This approach allowed me to keep substantial skin in the game while gradually reducing my original risk capital. If you want to capture similar opportunities in the future, here are the principles I followed that you might consider. First, develop a contrarian mindset. The biggest profits often come from going against the crowd when sentiment reaches extremes. This doesn't mean blindly fighting the trend, but rather looking for signs of exhaustion and overreaction. Second, focus on catalysts, not just technicals. Understanding what could fundamentally change market sentiment gives you an edge. In this case, recognizing that Trump's initial tariff announcement was likely too extreme to be maintained without modification was key. Third, manage your position size to allow for conviction. If I had bet too much on this trade, I might have been forced to take profits too early, or worse, exit at a loss during one of the pullbacks. Position sizing that gives you staying power is crucial. Fourth, have patience. The $32,000 profit didn't happen overnight. It took over a month of managing the position, weathering volatility, and sticking to my thesis even when it wasn't immediately validated. The period from April 9th to May 16th, 2025 provided one of those rare perfect setups where market panic created extraordinary opportunity. By understanding market psychology, focusing on potential catalysts, and maintaining conviction, I was able to turn that opportunity into a $32,000 profit. Will every trade work out this way? Of course not. But by developing the skills to recognize similar situations and the psychological discipline to act on them, you put yourself in position to capture outsized returns when they do occur. Remember, it's not about trying to predict every market move. It's about recognizing when the risk-reward ratio is skewed heavily in your favor and then having the courage to act. Look, I know how overwhelming the market can be, especially during volatile periods like what we just experienced. Having the right guidance can make all the difference between capturing opportunities like this or missing out entirely. If you'd like my personal help navigating these markets, I've included a link in the description where you can schedule a one-on-one paid consultation call with me. We'll look at your specific situation, trading style, and create a customized game plan to help you spot and capitalize on these high opportunity setups. Or if you're not ready for that level of commitment yet, join my Discord community for free. I share daily market insights, option setups I'm watching, and we have an amazing group of traders at different levels all helping each other grow. The link for that is in the description as well. Whatever path you choose, just make sure you're taking action. The principles I've shared today work, but only if you apply them. Until next time, trade smart and stay patient.